This is Dr. Tunji Babatunde, the course director on the course on resource mobilization in Africa. Uh, we are welcome to Module 3 presentation of the course, and the Module 3 is titled Constraints to Domestic Resource Mobilization. The essence is basically to take an holistic look at the set of constraints to domestic resource mobilization in Africa. Given the resource potential that is available to Africa that you have discussed in your last module, which is module 2. Why is it that Africa has not been able to attain such potential in terms of resource mobilization? This has actually brought about certain fundamental issues with respect to getting Africa to be able to mobilize enough resources that can actually be made for economic development transformation in the continent. And as part of introductory activities, I start by discussing the fact that the challenges confronting domestic resource mobilization, particularly in low income African countries, is the obvious fact that domestic resources are scarce where poverty is deep and widespread. The incidence of poverty in Africa is quite enormous. Inequality is also on the rise, and this actually has spread around the whole continent. So it is difficult because of the low income trap that most African countries are actually finding themselves. It will be difficult for them, for this set of low income individuals to be taxed and then get resource mobilized. Accordingly, increasing domestic resource mobilization has been described as a hard option when compared to mobilizing resources through official development assistance and foreign direct investment. However, such a position does not take into account the drawbacks and trade-offs associated with external resources. Moreover, many low-income countries are experiencing an erosion of domestic resources due to other economic policies. For example, tariff reduction, which actually been attributed to policies of trade liberalization in which most African economies have actually undertaken in order to reform their external sector. Reduced revenues from corporate taxation. Most African countries have been making efforts and giving incentives to promote foreign direct investment. They give tax holiday, they give depreciation allowance to most foreign firms such that they can come and establish in their country. The third issue is capital flight, which can be facilitated by capital account liberalization and should be questioned because they undercut domestic resource mobilization sometimes very seriously. So if you take all these three issues together, tariff reduction, reduced revenue, capital flight, these have tendencies of affecting the domestic resource mobilization effort of African countries. Similarly, if macroeconomic policy is heavily oriented toward price stabilization and inflation targeting, it may lead to high interest rates which constrain borrowing, investment and growth. And as much as possible, most African countries always try to stabilize their prices and also try to target their inflation. When you do this, the upshot of it is that you are going to have a cost and a framework of high interest rates that can actually constrain borrowing and also investment as well as economic growth at that particular level. So, and I said, in this particular framework, the set of constraints are quite enormous, but it will be interesting to categorize these constraints into four main categories. The first one is the structural constraints. The second one is the economic constraints. The third one is the political constraints. And the fourth one is what I call the social constraints. They have actually been presented in details with respect to the Microsoft Word document that is also attached to this analytical framework. So let's take them one by one. If you move down to structural constraints now, let's go down to structural constraints. Under structural constraints, you have inefficient tax administration, tax evasion, and tax avoidance. And I try to take a look at that: inefficient tax administration, tax avoidance, tax evasion, and tax avoidance. The systems in many African countries have been improved in recent years, and half of all African countries mobilize less than 70% of their taxes, because tax bases across most African countries are very narrow, and the tax burden also falls disproportionately on the small formal sector of the economy. And tax authorities also face serious capacity constraints and lack legitimacy. In most cases, too, corruption and negative perception of tax officials are major issues that affect tax mobilization in Africa. It is The sector is not really transparent, and that affects taxpayers' morale in being able to pay their taxes. Then also, like I said earlier on, most African countries grant excessive tax holidays to multinational corporations, especially those in the extractive sector of the industry of the country, and that actually affected the profitable level that can actually be sourced under this particular framework. One other particular challenge is also the capital markets inadequacy. Investment in African capital markets is inhibited by several factors. Uh, People perceive the continent negatively as a continent of conflicts, wars, coup, instability, disease, poverty, as well as mystery. And also, the capital market size of Africa is very, very low. Only the Johannesburg stock exchange is mostly the most visible stock exchange in the whole of African continent. So the legal and regulatory framework of environment in many African capital markets are still very weak and also lack transparency. The transaction cost too is not quite encouraging as well. One other issue under the structural constraint is trade liberalization and domestic resource mobilization. Trade taxes still accounts for the majority of tax revenue under this particular scenario. And now we used to have what I call easy to collect taxes, when we used to have a tariff, quotas, inflation taxes. Now we now have hard to collect taxes, which I call VAT, income, as well as sales taxes. And then the net impact has been revenue losses in several low income countries, and poor countries have also found it very hard to recover revenues lost due to tariff reduction. Another issue is the repatriation of proceeds from foreign direct investment in Africa. As much as possible, some of the foreign investors are in the habit of repatriating the proceeds of the foreign direct investment in Africa, given the loose capital control that we actually have in the continent. These are executed under the guise of getting incentive from the government, from African governments, in the area of tax exemption, waiver of all import and export licenses, rent-free land during the first 6 months of construction, 100% repatriation of capital. If Africa is going to mobilize enough domestic resources, we should not allow 100% repatriation of profit back to their uh, home country. Part of the profit should actually be reinvested back into the African continent. One other factor too is Africa debt burden. Africa debt burden heavily weighed on African countries' effort to mobilize, because they have to pay back most of this debt as debt service payments. So when debt itself is not a problem, the contention is where the debt is being utilized. If public debt is properly utilized, it can contribute to economic growth and diversification. But when it is inefficiently allocated, it can lead to high and unsustainable levels of debt servicing obligations, which has actually confronted most African countries as part of the constraints to domestic resource mobilization. And again, in most cases, the bulk of domestic resources are now being used to service external debt in Africa, because most of the debt obligation in Africa are for immediate consumption rather than being invested in productive resources. Also, again, you have the challenges of constraints to pension funds. You have the challenges of constraints, structural constraints, of limitation of the African sovereign wealth funds. You have the challenges of inadequate financial inclusion. You have the challenges of trade mispricing towards mobilizing domestic resources in Africa. You have the challenges of brain drain, in which the best brains in Africa lives for Europe, lives for America. Brain drain can be described as the process in which a country loses most educated and talented workers to other countries through migration. And the effect of brain drain in developing countries, as it affects the domestic resource mobilization cut across loss of tax revenue, loss of potential future entrepreneurs, a shortage of important skilled workers. The exodus may lead to confidence in the economy, which will cause persons to desire to leave rather than stay. Then you lose innovative ideas, as well as the investment that should be coming up in education. This actually cut across most African countries under this particular constraint, because of the fact that the resources that they should be paying to maintain those set of good educated workforce are actually not being allocated to those various sectors in which they are supposed to be giving them. Then finally, under the structural constraints, you have large informal sector that has actually weighed in on the continent. Most African economies, informal sector dominates the formal sector, and you cannot. Most of them are not under the tax net of the formal sector of the economy, and that have actually caused limited access to capital as part of the important constraint for operators working in the aggregate economy. The informal economy is often associated with increasing poverty and weak employment condition. Currently, the International Labour Organization estimates the average size of the informal sector as a percentage of GDP to be around 41%. This is huge when actually you want to mobilize domestic resources for structural transformation of the economy. We should not be talking about 11 to 15% of informal sector, but when you have 41%, then a lot of resources are actually escaping the former domestic resource mobilization, because they are huge. It's difficult for them to be able to bring them into the tax net. Now, let's take economic constraints now. We also have some set of factors that are also uh, affecting domestic resource mobilization, and they are grouped under the economic constraint. One of them is what I call the interest rate spread on savings and predominant forms of savings. The analytical framework, or what I call the paradox here, is that interest rate spread charged by bank on loans to private sector's customers minus interest rate paid by commercial or similar banks for demand times or savings deposits. Interest on loan is very high in Africa, while the interest paid on deposit is very low. So there's a mismatch under this particular framework, whereby people will not like to save their money in the bank, because when you go for loans, you get an average of 25%, and when you make the same deposit, they'll give you 3 or 4%. So that's almost like a 20% to 90% gap, in which that so this doesn't really encourage people to save in the economy. So it discourages savings, does not encourage borrowing for investment, especially among the small and medium scale enterprises in Africa. Then you also have the constraints related to remittances. When compared with other regions, money transfer to Africa are among the most problematic, mainly due to the two major challenges faced by the continent. Now, one of them is high rates of informality, particularly within the continent, and a regulatory environment that favors monopolies. Consequently, transfer costs are higher and remittance senders obtain less value for their money. As a result, remittances are being transferred likely outside of the former financial system. So that has actually encouraged money laundering on one particular part in the continent, because people always try to now use the informal sector, and transferring money through the informal sector have contributed to money laundering, have also contributed to terrorism activities in Africa, because most of the activities cannot be traced through the formal channel. Then one other big challenge in Africa is illicit financial flows. This has raised a lot of issues and it has affected a lot of domestic resource mobilization. International estimates suggested that between 20 to 40 billion US dollar of funds had been looted by corrupt leaders in low income countries and kept in safe havens abroad. Illicit capital flight cost about 854,061 billion into Africa between 1970 and 2008. And this is mostly prevalent for all exporting countries. That is where the illicit capital flight is actually most resource driven economy. And this will have enabled Africa to pay totally its foreign debt, which is about 250 billion US dollar. And we still have enough that is left, which is about $600 billion to be able to fight poverty alleviation, to be able to structurally transform African continent. So are some of the channels through which illicit financial flow negatively affects domestic resource mobilizations include distortion of prices, which is notably in the real estate sector, distortion of consumption and impact on imports, distortion in the resource allocation from high yielding investment to investment that run a low risk of detection, unfair competition, corruption, as well as a distortion of export and potential problems with investment and economic economic growth. Also, you have capital flight as an exchange as one of the constraints from the economy point of view. You have competitiveness as an exchange rate constraints. Then you have counter-cyclical macroeconomic policies. Policies of recent years have not really increased growth, but also create caution in a number of countries. The resulting stronger macroeconomic position in a number of countries increase the capacity of government to soften the crisis impact on the economies. And do you know that given the fact that in Africa we still have what you call the fragile and the post-conflict states that still lack the policy space for counter-cyclical measures that could ease recovery, which makes them particularly vulnerable to any shortfall in aid and remittances inflow. We have the challenges of COVID-19 now. The fragile and the post-conflict states are the ones that are feeling the impact, as well as the resource-dependent economies such as Nigeria. Those are the countries that are actually feeling the challenges of remittances, as well as the drop in the natural resources prices. Then you have high rate of tax concession and exemptions. Exemptions contract the revenue base, because when you give exemptions, people will not be paying adequate revenue. It also complicates the tax system, because some of these multinational corporations can hide behind it and then be getting unexpected, unnecessary tax avoidance from them, and that affects the domestic resource population. And this also opens the door to political capture. Exemptions have a ratchet effect. Once they are in place, they are hard to remove. And the prevalence of such exemptions actually affects the duty revenue that should be coming to the government. Then you also have high rate of tax concession and exemptions. Uh, you also have concentration of banks. You know, in most cases, the bulk of the deposit money banks are in the urban areas in Africa. You hardly find them in the rural communities. And if they are not in the rural communities, they will not be able to mobilize the savings in those rural communities for structural transformation of the African continent. So also the banking sector of most African economies are dominated by few large banks. So in most cases, without spreading banking framework to the rural areas, the banking sector will not be able to the ability to mobilize savings will still remain very limited in the African continent. The third form of constraint is what I called political constraints. Under the political constraints, you have corruption. Corruption challenges is quite pervasive in the African continent. The level of corruption is still considered as a serious problem within most revenue generation agencies in Africa. Revenue generation manifests itself in the form of smuggling, undervaluation, and under declaration of income and taxable goods and misclassification of goods. The custom department in particular has most consistently had difficulties in meeting its targets across its continent because of corrupt attitude. Therefore, various forms of revenue fraud could partly be an explanation for the low domestic resource mobilization in the continent. Then another particular form of political constraint is regional integration. There are so many regional economic blocs in Africa, with most of them in the process of implementing their various custom unions. Currently, the proliferation of uh, economic blocs in Africa has made it so interwoven that we cannot really see the effectiveness of these economic blocs. The key objective for the custom union is to widen markets for goods produced within their respective region. However, this also comes with challenges since tariff between the countries in the union will be abolished. This will require the country to immediately replace the revenue loss through other innovative ways. Africa is planning for the African Continental Free Trade Agreement. It's coming into force now. In the short term, the set of taxes that are actually collected from this before the advent of AfCFTA will be affected. But using other innovative approach, we should be able to actually manage this and get another form of domestic resource mobilization in place to replace this lost tax revenue to the government. Then you also have another constraint in the form of governance. There are many challenges stemming from public sector governance and planning. There is a pervasive disconnect between public financial management and national budgets and planning, which makes it difficult for countries to identify funding gaps and channel existing funds into priority development areas. Effective economic governance institutions are essential not only for combating corruption but also for structural transformation and inclusive development in Africa. Then finally, another political constraint is what I call civil strife and insurgency. In Africa today, it is worth to mention the strong negative association between conflict and economic development, and this is due to the difficulty to mobilize resources in a conflict environment. Boko Haram has been occupying a good size of the northeastern part of the country since about 7 or 8 years ago. This has actually affected the business environment under this particular region in Nigeria. Political violence has a major impact on economic development. No business will want to go there and develop because the security challenges of operating in that environment is quite high. And the effect of conflicts are quite numerous. For example, the effect of organized political violence is likely higher than the direct capital destruction impact. The risk of civil war and violent riot reduces good, just like we had in Nigeria recently when we had EndSARS challenges and almost everywhere was locked down. So this actually reduces economic growth. If that had actually occurred for more than 1 week, then definitely Nigeria would probably have gone into economic recession because the challenges of COVID-19 with respect to the oil price shock is still affecting the economy. So in most cases, you have in Mali, you have the in Sudan, you have the Janjaweed, you have the Tuareg in Mali, you are in Mauritania. So this cut across. You cannot mobilize domestic resources wherever you have such a challenge that is going on. And then also you have the social constraints. That is, and the first one there is social contract, that is poor fulfillment of tax obligation. In Africa, we don't always like to pay tax. You will find it difficult that it's only in cases whereby the government removes the tax right from the source of income. That is only situation that people always want to pay their tax willingly. People, I mean, individuals in Africa don't always like to pay their level of tax. And this is a social contract in which taxpayers are expected to fulfill their tax obligations within the context of revenue mobilization and taxation. The social contract is simple. Citizens are expected to pay their taxes, and in return, they expect to share in the benefits of governance. In essence, in paying taxes, citizens expect their government to also reciprocate with good governance in terms of good infrastructural services, good security, as well as good institutional services with respect to education, hospital, healthcare, highway building and maintenance, welfare programs. Compromising this social contract has far-reaching implications for compliance with revenue mobilization efforts in Africa. And a myriad of studies are proving that the more value citizens see in the taxes they pay, the more likely it is for them to voluntarily comply. That the willingness to pay taxes will always come from the fact that what they see the government is doing with their resources. And it's also funny that you see African citizens moving to Europe and America. Willingly they pay their taxes, but once they are back in their own home country, they find it difficult to pay this level of taxes. So social contracts around the payment of taxes is flawed for two reasons in Africa. First, the taxes mobilized do not sufficiently translate into improvements in the delivery of public services, and the benefit from governance seems to benefit only a few. Second, in Africa, improvement in public services tends to be overshadowed by high levels of corruption, opaque public expenditure, embezzlement, as well as procurement scandals. And corruption is indeed a major barrier to economic growth and basic freedom in Africa. So that is why people are skeptical to about their social duty to contribute to a revenue system when you know that when you are paying this amount of your level of taxes, it's going to be embezzled. So people doesn't really want to pay their taxes. And also there's unfair enforcement of tax laws. People doesn't really get tax laws to be enforced in Africa. One other particular factor under the social constraint is what I call social assistance and the dependency syndrome. Social assistance programs are often criticized on the grounds that they create moral hazard, where individuals who are insured change their behavior in adverse way in response to incentives offered by insurance. A common argument against social assistance, generally put forward by elites and some middle class circles, is that it breeds dependency among beneficiaries, and this undermines people's sufficiency, self-sufficiency, and motivation to climb out of poverty through their own effort. In Africa, we always believe that the government should just do everything to us. We don't bother that what also can also do for the community in order to also be able to develop effectively. And this actually has a way of reducing domestic resource mobilization, because we always believe the fact that us government is giving social assistance, it is our right, our responsibility, and the fact that it's going to increase level of poverty and inequality. So definitely we need to actually take a look at this as one of the constraints of social issue in Africa. Then declining value systems. Value, as experience has shown, pervade the whole of one's life. Everywhere, value affect our behaviors. They are at the heart of the rules which form part of our lives, underpin the laws the society wants us to obey. And the question now is, what are those values the society holds in high esteem and want everybody to live by? We want everybody to fulfill their individual obligation to the government. What are the fundamental principles that guide our conduct as African citizens? As African citizens, we expect the best from the government. Are we also ready to give back to the government under that particular scenario? Why has the society displayed so many like a lackadaisical attitudes towards values that drive our society in the past, when our continent was always cast in good light. We used to have it very, very good in terms of our value system. But over the set of years, this value system have actually collapsed. We used to have a time whereby once they find anybody guilty of corrupt practices, the society ostracize such the whole family of that individual. But nowadays, even when people are found to be, guilty of any form of corrupt practices, the society celebrates such a person and go to meeting to get their own share of that particular corrupt proceeds. So this has actually been a mismatch of where we used to be and where we are now in terms of our value system that have actually declined in the continent. So I brought up a couple of recommendations and policy options that African countries can actually adopt in terms of overcoming this set of constraints in order to increase domestic resource mobilization in the continent. And I said, good enough. There need to be a strong involvement of the community in domestic resource mobilization. We need to promote good governance, transparency, and fairness of the system and information about the objective use of such funds that has been mobilized. When citizens in Africa sees what their money are being used to do, what they are spending the taxes they have mobilized from them on, there's every tendency that they too will want to pay more. It's a two-way scenario. The government too has its own obligation to fulfill. And I also said that planning is fundamental for diversifying productive sectors for financing development. We need to develop administrative capacity to opening policy options for more progressive tax policies in the medium run. In Africa, we need to simplify and rationalize tax system and make them more transparent. We Most of the tax system in Africa is obscured. It is not transparent. This is one of the things we need to do in Africa. Countries to maintain sound macro fiscal position for the protection and the growth of market access. Global Investments Bank needs also to do more capacity building as well as client education. African countries should avoid financing their development through debts because of high interest rate on loans, making them unpayable most of the time. And that means we need to prioritize domestic resource mobilization. The challenges that comes with debt is the fact that the debt servicing is always huge at the end of the day, and the next generation are actually going to be the one that will be facing such challenges. African countries also need to diversify their source of revenue to avoid dependence on external aids. We need to strengthen management of pension funds, build capacity of pension funds, building capacity of pension fund will enable trustees and managers to exercise their duty adequately. It is imperative that African countries strengthen their fiscal contracts with their citizens by building effective, transparent, and accountable domestic revenue mobilization systems, while improving their public service delivery system to benefit all citizens in the continent. So that is actually the whole framework of the lecture. At the in the paper that you have with you, the Microsoft uh, Word document that you have with you, at the beginning of each of the sections, I've provided what I call motivating questions, and at the end too, I provided what I call discussion questions and case studies. I expect you to go ahead and answer those questions. And if you have any challenges in terms of comments on what I've actually presented, kindly feel free to exhibit it. I'll be there to actually take your comments and your content. But by and large, I want us to reflect on this set of questions. What are the major constraints that your country faces in mobilizing domestic resources because this set of constraints vary across economies in Africa. What may be the major constraint in Ghana may not be the major constraint in South Africa. What may be the major constraint in Kenya may not be the major constraint in Tunisia. So I want you to now discuss the intensity of these constraints in the context of your country. How much can be learned on the constraint management from more developed countries? Asian economies have been able to do very well with respect to domestic resource mobilization. I will implore you to take a look at what Japan has done, Thailand, Malaysia, Indonesia. These are countries that have comparative characteristics with that of Africa. And beyond country specific, are there lessons that we can actually learn from other high growth developing countries? And what specific actions can we adopt that will help Africans to get a better deal from natural resource extraction? And this basically can actually be in the different political contexts that we operate in Africa. For example, Botswana are often held up as examples of good governance in the natural resource sector. To what degree does this still affect political rent seeking as well as corruption in Africa? So, this is a very good opportunity for us to reflect on our individual countries' constraints with respect to domestic resource mobilization. So, thank you very much. Uh, Thank you very much. And I appreciate that we get along to each other as we go along. Thank you.